Thank you so much for joining us today for one of our weekly Fortune 500 focused webinars. My name is Sam and I will be your moderator today. In just a second, we are going to be joined by Michael Corgiat. He is one of our experienced financial advisors, and Michael is going to be discussing some strategies with you related to value investing amidst a high inflationary environment. Throughout his presentation, I will be fielding any questions you have, so I encourage you to ask away if you have any questions. Our question box is completely anonymous, and I will make sure that someone responds to you in a timely manner. And after this presentation has ended, you will be redirected to our homepage where you can take advantage of our complimentary cash flow analysis or make an appointment with Michael Corgiat or one of his colleagues if you wish. So I encourage you to do that. And without further ado, let's get into the presentation with Michael Corgiat.
Thank you, Sam, and thank you for everyone for joining us today. As Sam mentioned, we're going to discuss some strategies in value investing and the benefits that investing in value equities can help you in inflationary environments amongst many different conditions. We are a big proponent of value investing and have been for a long time. Again, my name is Michael Corgiat. I am one of the firm's advisors. I've been an advisor for quite some time and have always believed in investing in value-oriented equities. A balance between value and growth is very important in a client's portfolio. And we're going to talk about many of the different aspects of why you want to consider investing in value stocks. First, the intrinsic worth of value stocks. You're identifying and investing in companies that are undervalued in the marketplace based on their underlying worth. In other words, the base value of the stock might be $50, but the stock is trading at $30. It's trading below book value, which means it is a value company and it has an opportunity for the underlying price of the security to grow. Those companies always have strong fundamentals, strong earnings, strong cash flow, asset bases that typically are very resilient in inflationary times compared to overvalued counterparts, which in many cases are growth stocks. They always typically maintain low debt levels, which is very important. Companies with lots of debt, especially in a higher interest rate environment like what we are in right now, can overburden a company with interest payments. And they have high cash reserves, which also goes hand in hand with low cash. So they've got lots of capital available to reinvest in their business, especially during inflationary times when times could be tough for their competitors. They've got that cash to turn on different sorts of business within the company and produce more product, and therefore maybe maintain even more cash flow and sell more products during these inflationary times. Operational stability. These companies, again, have strong cash flows and can maintain those cash flows and their operations, and in most cases, pay dividends during these inflationary times. And they do the reinvestment potential as far as strong cash flows allow companies to reinvest in growth opportunities, enhancing their resilience against inflation. Significant pricing power. They can pass on price increases to their customers because most of these companies make products and or provide services that are essential to consumers, whether they're consumer discretionary or a utility potentially. These are services that people are not going to quit using, or the products that they produce, like food or foodstuffs, just to name one. So they can maintain profitability even in inflationary times because they can pass on price increases to consumers. And we have seen that at the grocery store and at the gas station. Defensive sectors, I mentioned a couple of these already, but stable demand companies in the defensive sectors like utilities. I mentioned healthcare is another one. Consumer staples. These are sectors in the economy that will provide stable and steady returns on investments over time, which is just great. and consistent dividends. I mentioned that most value stocks do provide dividends to investors. All right, and dividends are important to me as a investment professional as well as my clients, because earning a dividend while you're waiting for your stock to appreciate is definitely a benefit. You may take that dividend as far as your income needs in retirement, or for whatever you might need the dividend for, or you might reinvest it in more shares within the company. So getting paid while you wait is what I like to say. And these companies, in the most part, are always focused on growing their dividends over time, because obviously inflation increases the price of all goods and services. Well, you know what? You're going to need more dividends as time goes on, and the focus that these companies have is very important in increasing their dividends. They know and see the value of that to their investors. The long-term perspective, the historical returns over the long term, these stocks typically do go up and appreciate and exceed inflation for the most part, year after year after year. And I mentioned undervalued stocks. Focusing on undervalued stocks with the potential for growth and recovery can lead to longer term returns. Margin of safety. I sort of mentioned this in the beginning. Buying companies who have prices below their intrinsic or book value provides you with a huge margin of safety. And I mentioned earlier, a company might have an intrinsic value or a book value of $50 per share. A value stock would be trading potentially at $35 a share. I mentioned $30 a share earlier. Okay, so the stock is trading below its intrinsic value. So it has appreciation opportunities. And if that company pays a dividend, that's a bonus on top of the opportunity for the capital appreciation. So you buy the stock for $30 a share, even if it were to get in financial difficulties, or a suitor might come along and want to buy that company. Listen, there's a lot of margin for safety in that $20 per share gap. And that gap protects against volatility and the long term, especially in uncertain economic conditions. So again, very, very important. Growth stocks many times are priced much higher than their intrinsic value. And for example, company might be trading at $150 a share and only have a $50 per share book value. There is no margin of safety. There is a lot more downside than there is upside potential, like you would have in value stocks. And again, quality companies in defensive sectors, we mentioned these already. Utilities, healthcare, consumer staples provide stable returns and steady returns over time. And these sectors are less sensitive to the economic cycles, as I mentioned, even during economic uncertainty and inflationary times. These companies provide services and goods that consumers still need and want, even when their prices are going up. So there, real estate investments, real estate assets are also very important. Many value companies own a great deal of real estate. And that real estate also provides a hedge against inflation, because real estate typically goes up in value during inflationary times, even quicker than in non-inflationary times. And companies who hold a lot of that real estate provide a huge natural hedge against inflation with that real estate on their books. So I said a lot, value investing and some of these strategies and the reasons why you might want to consider value equities. Again, having a balance in your portfolio between what I like to call old economy, which is value stocks, and new economy, which are growth stocks, is very important. Dividends are important to me. They are important to my clients as well. Most growth stocks don't pay dividends, whereas value stocks do. You've got that underlying intrinsic value, so you've got capital appreciation opportunities. All of these things are important to keep in mind. And finally, just having an overall plan is very important. This is something that we would be happy to put together for you. Why would you want to consider us here at the Retirement Group? Well, we've got an awful lot of experience. We've got offices nationwide. I'm based here in the Midwest. We've got a great deal of knowledge on many Fortune 500 companies' benefits programs. We like to consider ourselves very smart when it comes to your benefits programs, and we're happy to offer a complimentary financial analysis. We like to call it our Retire Kit or a retirement cash flow analysis. It's a complimentary service. All you have to do is reach out to our office. You can follow us on our LinkedIn page. I strongly recommend that you scan that QR code on the right and follow our LinkedIn page. We've got a lot of great information on our LinkedIn page. You could scan the code here on my left and schedule a meeting with myself or one of my colleagues. If you've got any questions, give my office a call at 1-800-900-5867 or send an email to info@theretiregroup.com, and one of our colleagues will get back in touch with you. Again, I appreciate your time and I welcome your questions, and I look forward to talking to you, some of you here in the near future. Thank you and have a great day.